Hi, everyone. Welcome back to the Weekend Charts. Huge show for today. Charlie Bilello here. And with me today, special guest, Jamie Battmer, Chief Investment Officer at Creative Planning. Jamie, people are getting tired of listening to my voice. It's great to have someone else on and get another voice, another opinion. Are you ready to go here? We got a lot to talk about.
I am ready, Charlie, and thanks for the invite. Appreciate it.
And what's that you're wearing there? You got a little Chiefs gear? You just feeling
It is
confident?
a someone who's been a lifelong, passionate fan of my hometown Kansas City Chiefs, where our corporate headquarters are. We are hoping for another victory over the San Francisco 49ers this weekend. And the first 40 some odd years of my life was nothing but agony. So while we are in this golden age, please everyone know that this fan, unlike his kids who know nothing but Chiefs victory, has paid for it through a lifetime of blood, sweat, and tears.
So not a bandwagon fan, and I can identify with the blood, sweat, and tears because I'm a New York Mets and Jets fan, and because I'm a Jets fan, there is no Super Bowl to root for. I just usually root for the underdog, and surprising to me this year, the Kansas City Chiefs are underdogs, 2-point underdogs, kind of crazy. So I'm going to be rooting for the Chiefs. I was shocked to kind of see that, given Mahomes and everyone else, but we'll see. I'll be rooting for the Chiefs. Okay, so let's go into the docket for today. We got yield curve inversion, longest ever, more all-time highs in the market. Nvidia, we have to talk about Nvidia. Of course, it just continues to run, now bigger than the entire energy sector in the US. Federal Reserve, I know you have some thoughts on this. My opinion, they shouldn't be in a rush to cut, and it seems like Powell right now is in that camp as well. Profitability and paper hands, we're going to discuss. Profits matter once again in the market. McDonald's, consumers, certain consumers not really loving the price increases at McDonald's. We're going to dig into that. The secular office downturn, a little bit of rumblings in the commercial real estate sector starting to impact banks again. We're going to dig into that. And demographics and destiny with China. I know you have some interesting takes there. And lastly, we're going to end with a positive note talking about the increases in wealth across generations, but particularly among the younger generations. Okay, that's a lot there,
Yeah,
Jamie. But
not loving it. I get it. I get it. I get it.
yeah, it's going to be a fun one. And we're going to start with everyone's favorite, the yield curve inversion. And just to remind people, if you're not familiar with the yield curve inversion, it's just this crazy situation where you're actually getting a higher yield on short-term security, so like a 3-month treasury bill, than the 10-year yield. That's not normal. Normally, you would want a higher yield or demand a higher yield on these longer-term bonds, like a 10-year. But for now 472 days, Jamie, we've seen this yield curve inverted with that 3-month above the 10-year. Of course, the Federal Reserve's interest rate hikes creating this situation, keeping it there. And why everyone is talking about the yield curve historically is because it's been a pretty good leading economic indicator of an oncoming recession. Not immediate. There tends to be a lag, the average lag going back in history around 24 months. But the question people are asking, well, where's the recession? Didn't happen last year. Still no signs of it today. What do you make of this longest inversion in history? And are we going to see a recession? At some point, of course, we will, but is it coming anytime in the near future?
Well, as a classically trained economist, I know that economists like these leading indicators. They always say, we've called 10 out of the last 5 recessions. And so, yeah, the market can be crazy a lot more than you can be saying. And yes, it has had this historical track record of leading to this, recession outcome after a couple of years. But as you can see with the gray lines in here, the small gray lines, that's denoting, recessionary periods anyways. They happen. And it's part of the game. 3 out of 4 years the market goes up, recessions occur, kind of every 5, 6 so years. And so it's gone on quite long, but those that have tried to use that as a market timing mechanism have been failed by it. And, the longer you're wrong, the more you got to dig out of the hole when it inevitably happens just to say you're right. And so, yeah, a lot of these leading indicators like that, they work, but even, there's that list of what 10 leading economic indicators. The group that does that's a wonderful group, and that they've even referenced that. Yeah, it's
There you go.
sometimes it works, sometimes it doesn't, and so yeah,
So the
perfect
conference
add-on
board,
right
you're
here,
you're
Charlie.
you're being kind to them because they started predicting a recession based on this leading indicator in the first quarter of 2023. Then they pushed it back to the second quarter, then the third quarter, then the fourth quarter, then the first quarter of this year. And now I think most recently they're saying the first half of this year. And likely, in my view, that might be pushed back again. Eventually, it will be right. What's interesting, though, Jamie, right this time around, is that the stock market has been the kind of standout, not confirming it, right? So we've seen a downturn, definitely in the housing sector, right? Definitely in terms of manufacturing. If we look at ISM and other indicators, some credit indicators, but the stock market, starting really last year, moving the opposite direction. So I think the big debate here, well, is the stock market right or is the bond market right? And there's that saying the bond market's the smart money. But as you said, from an investment standpoint, there's really no way to invest based on that yield curve indicator because there's variable lags, right? So even if you knew when the recession was going to begin, you wouldn't know when the stock market's going to price that in, and you don't know when the recession's beginning. So let's say it's not for 3 years, right, from the start of the yield curve. Well, that makes a difference, right? And the market could have a very quick reaction to the recession at that time, and by the time you react to it, it could already be over. So perhaps we saw that reaction in 2022, and perhaps the market now has already recovered it from it and is moving on. But we can't. We don't know. We only know in hindsight. I wouldn't say like if this indicator is dead that it means nothing, but from an investment standpoint, 100% do not act based on the leading indicators. So let's talk about the stock market and those all-time highs here. S&P 5,000, Jamie, we had a little bit of a gap right between 4,800, 4,900. We had that bear market. Took a little while there, 757 days to get up to 4,900. That was the longest gap that we've seen between 100-point milestones. You have to go back to 2000 and 2013. That was really long, 13 years. This time we waited a few years, a little over 2 years, but still, it felt like an eternity for people that were living in it. Now we're above 5,000, and I don't know what your forecast was coming into the year for your S&P 500, but this kind of surprised me that these levels weren't higher after the gains last year. Usually, they're very reactive, these strategists, based on the prior year. Did this surprise you at all, seeing these pretty low price targets? I think the average was around 4,800, and we're already above that level today, above 5,000.
It just reinforces that for all of us out there. I mean, in the short run, the only real answer is we have no idea. Now, like you've highlighted before, Charlie, what, for the first time in 25, 30 years, beginning 23, the consensus of the so-called Wall Street, strategists, that smart money that I think you might be giving a little bit too much street cred for. But for the first time ever, or since they started measuring, they essentially projected as a whole that the S&P 500 would be down. Well, no, what we have last year instead, a great 20 plus return year. I always like to even harp it back that same squad of strategists picking beginning of year stocks in 2008. Those of us old enough to remember the glories of the global financial crisis, I think the projected uh, growth for the S&P for 2008 at the beginning of the year was 11%. Well, it was down 39% instead. So they just missed it by an even 50%. That's all. And so really, yeah, in the short run, no one knows, but these things happen, and like the chart Charlie just showed, it took a long time to recover back to those all-time highs. We did just go through a very, very, very difficult year for both stocks and bonds. I mean, by some measure, by some measurements, 2022 was the worst year for bonds ever. So using that as an indicator, okay, yeah, we've navigated this storm. Um, yeah, it took a long time to recover. So if anything, if you're going to be guessing, and that's what it is in the short run, you say, well, maybe there's a little bit of time in between that storm and the next one, but 100-year storms come around often every 3 or 4 years. So you really just never know.
Yeah, that's a good point there. The bond market interesting because we have the S&P now hitting all-time highs seems like every day, and this year it's already 9 so far. We're only at, in early February here. At that pace, and that's saying a lot. If it were to continue at that pace, that would surpass the record from 1995. And if you remember 1995, Jamie, this is the example that I tell people, and we get this every year, right? At the beginning of the year, what's the number one reason people are not putting money to work? And I'm talking about long term money, money you're not expected to need for 20 years. It's always, well, the market's due for a correction, right? And man, it felt like it was due for a correction throughout the entire year in 1995. There wasn't a pullback greater than 2.5%. Now, that's an unusual year. Typically, almost all the time, you have at least a 5% correction. If I had to bet this year, we're going to see at least one. I think the average is around 3 in a given year, but you never know when you're going to have one of these long streaks without one. And for an investor that doesn't need that money for 20 years, trying to time this can be extremely, extremely dangerous because when that pullback came, and I think it didn't come until July 1996, it was like a 7% pullback, and it only brought you back, you know, a few percent, like in terms of you're not getting back to the beginning of 1995. You're getting back to like, you know, a few months prior, right? And that's not enough for an investor who got out waiting for a correction or wouldn't get in waiting for a correction is going to need much more than that. So that like timing instinct that we all have, like I want to buy low, there's a correction coming, it's likely to happen, it will certainly erase when it does some of the gains, but putting off that investment that's a really a long-term thing, waiting for that can be very, very difficult.
Yeah, I'm old enough to remember 1995. I'm not as old as you, Charlie, but I'm old enough to remember that.
Pretty
But yeah,
close.
it just reinforces that, I actually didn't believe this at first, but you say, okay, yeah, I'm waiting for a correction. The data actually supports, our president CEO put this out not too long ago. If you only invest on, days that the market is hitting an all-time high, your returns are actually better than if you just investing on any day. And so the idea kind of growth begets growth. And I didn't believe it. The empirical data supported it. If you were only investing in all-time highs, that's actually a win. But looking more, you're not always going to be able to do that. And the market is a flowing ocean, and you just have to ride the waves and take advantage of it. I mean, those 10% corrections, you don't pretend like you can know when they're going to come, but when they come, be ready to take advantage of it. Be ready to make sure you're rebalancing to take advantage to participate more in the eventual growth. Look at that as an opportunity to do tax loss harvesting, create, higher tax alpha, better after tax returns. That's how you look to take advantage of those corrections, to do something that's going to be beneficial for the portfolio significantly over the long run, instead of trying to pretend like when they're going to come.
Yeah, nobody knows. We only know a correction's coming. We know the averages, the odds. Bear market once every 4 years on average, but gosh, the recent years have proven that that's not spread out evenly. We had a bear market in 2018, again in 2020, again in 2022. So maybe now we're due for a few years. No one's really thinking this way without a bear market, right? But I wouldn't be shocked also if we had another one in the next year, right? Nothing should really surprise you as an investor. And here's the data based on all-time highs. I went back a little bit further than the study that you're referring to that Peter was looking at, went all the way back to 1929. And with any data set, this is important for people. If you include the Great Depression, things changed a lot, right, in terms of the averages. So buying that all-time high or those all-time highs in 1929, well, that brought down the averages a lot. And but still here, if you're looking overall, 1 year later, almost no difference between all-time highs and other periods, which should tell you there's not a statistical reason, there's not a data-driven reason to do anything, buy or sell based on an all-time high. It's almost like any other day. Now, when you're going out longer term, let's say 10 years, 20 years, there is some credence that when you're in a large drawdown, there tends to be better returns. And that should be intuitive. That should make some sense, right? Because stocks tend to be cheaper after a big drawdown. So yes, all else equal, I'd much rather you buy low than sell high than buy high. But a natural occurrence of the market is to be higher because there's growth, there's inflation, and 20 years from now, hopefully, S&P 500 earnings will be much much higher, right? Regardless of what happens in between, and that's what the bet you're making. It's not anything short term. It's just saying 20 years from now, things will be better than they are today. And you have to have that view. If you don't have that view, you can't be an investor. Now, in terms of the hottest areas of the stock market, semiconductor chips really have become the new oil. And this is kind of a ridiculous stat. First, Nvidia market cap up to 1.7 trillion. Now, in February 2019, so 5 years ago, $90 billion market cap. That's a 19x increase in 5 years. Right, just stunning. Far and away the best performer in the S&P 500. Put out this chart on Twitter and got a lot of reaction to it. I call it Twitter now. It's X. Yeah, I keep mixing that up, Jamie. But every single company in the S&P energy sector combined has a total market cap of 1.58 trillion and Nvidia 1.7 trillion, higher than all of the companies in the S&P 500 energy sector combined. Does that does that mean anything to you? And here's the kicker, right? Because I didn't post this stat until later, but Nvidia's net income currently 19 billion. The net income of the energy sector 147 billion. So a lot is built into that number in terms of Nvidia and expectations.
Yeah, that really is amazing. That stat at the bottom, that just highlights it there, Charlie. I mean, it's that much excitement about what the potential use moving forward is versus something that's dwarfing it in current income right now. And yes, the excitement with AI, Nvidia just unquestionably has just been the epicenter, almost unique in history of bubbles, and not necessarily saying there's a bubble or not, but just excitement from a new a new addition to the economy, a new way to propel us forward. They've just been, it's almost been more focused in them than anywhere. And but I mean, yeah, 40+% year to date already. Hyper growth. And yeah, speaking apolitically, yeah, we could, it's not if we want less gunk in the air, or or when we'll be able to, remove our economy from dependence on fossil fuels. But regardless of what they're actually generating now versus something that seems to be a a major component of the future, but the keywords is seems to be in that.
Yeah.
So riding a lot of hopes, really
What I
focusing on.
like to say, yeah, with these type of things is and this is one of the most extreme examples we've seen because it's just so captivating. The growth rates, and it's real, unlike some of the .com names back in the day, there's real profits and real revenue here, and the growth is substantial. The question is, are investors getting way ahead of themselves? Are they acting as if the future has already happened? So let's say 10 years from now, I think Apple's is the number one net income company today in the world, 100 billion in net income, right? So still lower than the energy sector, but much closer. Let's say 10 years from now, Nvidia has a net income of 100 billion, right? Like it does so exceedingly well over that period of time. Was it justified to pay the type of multiple today? Well, that depends 10 years from now what investors at that point in time, what they're assigning the multiple on it at that point, right? So even in the best case scenario where it grows 5x net income, let's say in the next 10 years, which would be absolutely insane for a company that's already this big, you still have to expect, in order to profit for it as an investor, that the multiple is going to remain elevated, right? Because of the price you're paying today is so high. I think that's the point investors are losing here. And as far as the energy sector, I don't think we're we're not, our dependence on energy is not going away, right? So it's just, in terms of these, maybe these profits might change. They're certainly not going to grow as fast as something like Nvidia, but for investors to place a premium in terms of these AI chips over the entire energy sector, to me, is a crazy thing. And to me, Jamie, it's assuming that there's going to be such a lack of competition over the next 10 years that it's almost unimaginable that someone would be able to keep, a company would be able to keep, in a capitalist system, would be able to keep this type of profit margins that they're keeping. I think they're running well over 50% for this type of business, which is absolutely enormous, right? That, and a competitor is not going to come in. And speaking of that, I just saw this headline before we jumped on the show here. Sam Altman's looking to raise trillions of dollars for new manufacturing of chips and everything related to it. So, does any of that seem like a likelihood here that someone will come in and say, this is a pretty good business, we're going to try to get some of that and offer it at a lower price?
Yeah, just using history as our guide. The alpha dog today is just so rarely the unquestioned alpha dog 10 years, 20 years ago, especially 30 years later down the road, where they really have to justify this, they really have to maintain that total domination. They need to, eliminate any kind of competition like you're seeing here from these outside competitors. But just through history, it just the great names change, but there's still great names out there. That's why primarily in the public market space, we like to own the market. There's always going to be great companies that provide great ways to provide goods and values, goods and services that you and I want to buy. But those names are always changing. And so if you're just investing, say domestically, and yeah, it's garnered a lot of the returns recently, but you're broadly investing in, say, the largest companies. You're not picking out Nvidia. Nvidia just happens to be there now, but you're more diversified over the long run because you're just always going to be investing in the largest, most profitable, successful companies, regardless of what the underlying names are. Because again,
So,
what's Nvidia today? Charlie, you'll remember these. You're old enough to, Eastman Kodak,
Cisco,
right? Yeah,
Cisco in
Cisco.
2000, right, would
Yeah,
be the big
yeah.
example that comes to mind. And that, a company that's still around today, is much more profitable today, has higher revenues today, but its stock price not much higher than back then because investors were paying such a high price. Not saying it's going to be the same, but what's the biggest pushback? How do you explain it to investors? You meet with a lot of clients, they're asking you, it's we haven't seen a divergence in performance this wide since the late 1990s in terms of US big tech large cap growth versus everything else. And I would say part of the difference today is these are companies that people are using every day, right? So you got Microsoft, Apple, Amazon, and Google, four largest companies. They are products we use every single day, and they happen to be the best performers. And now we added Nvidia to that group as well. But what do you say to these people? What's the case for investing outside of that, other than, okay, history has taught us that? What's the case to say, is it a risk management decision? Is it to say that there's cycles to things? Is it to say that the valuations are already reflecting optimism over that? What's the best case you can make to people to kind of talk them out of, because they have exposure to them already, and it's a big exposure. The Magnificent Seven is now 30% of the S&P 500. Nvidia, if they've benefited from that, right, in their portfolios. But the question that they're asking is, well, if I just took out the other 493, Jamie, I would have had a much better year last year.
Yeah, but you know, you don't even have to go that far back in history. Just go back 2 years, and that 493, the other 493 constituents of the S&P 500. When the Nvidias, when the Apple, when they were down huge in
2022.
2022. In
Yeah.
2022, these others actually held up a little bit, significantly better. Again, dramatically better, 4 or 5 times as much better. And so the inverse was true in 2023, where these huge tech names just catapulted to the top. And you're absolutely right, Charlie. I mean, they're a ubiquitous, profitable component of society. I mean, we're all addicted to our devices. There's probably thousands of Amazon, shipments, being clicked on right now, just between when I started making that statement and now. So it's probably, but yeah, 2000, that wasn't profitable. But again, you have to look longer term. Say, you know, usually when these things start having names like the Magnificent Seven, .com, darlings, there was the Nifty 50 that was part of, in the 70s that had these same kind of like really bubbly valuations, but they were companies that made money. Again, there was the Coca-Colas of the world, it was the Exxons. So these weren't companies that were unprofitable. That 2000 kind of the excitement of the infancy of technology led to that, but it's happened before. And again, using history as our guide, usually it just comes down to valuations over the long run, and they can only be stretched so far before they have historically always over a long enough period snap back. And that's why you can't chase the hot dot. Yes, you have tremendous exposure there now, 30% plus exposure in large caps typically, but you cannot have you should not be flowing extra there. I mean, there was the entire decade where large caps made nothing. I mean, 0% over a 10-year period where these other instruments, made 100%, 200%, 300%. And so there a long enough time horizon, there's a reversion to the mean. And don't just get caught up in the excitement of the new technology, because it is very exciting. But again, so was the internet, so was the industrial revolution. And oftentimes that irrational exuberance leads to more tears than cheers,
Yeah.
for those that overweight themselves.
Yeah, I don't think, yeah, it's been so long. I don't think anyone remembers 2000 to 2010 like that.
Yeah, gee,
It's
probably no one remembers the Nifty 50 then. So maybe
yeah,
I should
yeah,
get a more updated.
yeah, definitely it's a nifty 50. But what I like to say is that you don't have to be betting that these things are going to have a big crash, right? In 2000, 2001, 2002, it was epic crash. I mean, it was 80% for, NASDAQ 100 type names, and Amazon was down over 90%, right? So it doesn't have to be that same way. And for you as a shareholder, as an investor, to benefit from diversifying, let's say it's just even over the next decade between growth and value and US and international and Magnificent Seven and the other four nine. Let's say it's even, but it flips back and forth, right? From year to year. Like you said, 2022, they underperform, 2023, they outperform. Well, as an investor, you're still going to benefit from that because it'll smooth out the overall return. Then you're more likely to stick with that portfolio, which at the end of the day really is all that matters. Investing in a diversified portfolio, the reason you do it is to increase your chance of having an optimal return over a long period of time. It's not to get the highest return. Like Nvidia may very well outperform a diversified portfolio over the next 10 years, but that ride is going to be incredibly difficult to stick with, right? So we
Yeah.
keep that in mind. You have to have some humility. You have to say, I can't predict the future. We don't know what Nvidia and challenges are going to happen for it. Just like Tesla, when it had a crazy valuation a few years ago, it seemed like it could do no wrong. And now it's a good deal lower than back then. It was trading at 30 times sales. Now it's trading at 6 times sales. And now you have Nvidia at 40 times sales. It seems like nothing will ever go wrong with it, but there will be something. I don't know if it's AMD. I don't know if it's Sam Altman, but it'll be something that's unexpected that goes wrong, and that hasn't happened over the past year.
I can lie to myself or hope it won't happen, and that the Chiefs are always going to be going to the Super Bowl 4 out of 5 years. Maybe that can happen. Just like maybe the top dog can always stay the top dog, but everything in nature, in life, in sports, in stocks, it so rarely happens. And Charlie, you mentioned Tesla's kind of fallen off of the Magnificent Seven
Yeah, they
list.
want to kick it out.
Yeah, but you know what? I mean, I'm gonna further date myself with my pop culture references, talking about, early 70s stocks, but even earlier movies. I mean, that the Magnificent Seven came from, that great, Yul Brynner movie there from probably what, the late 60s. Anyone old enough to remember that, only three out of the Magnificent Seven cowboys survived. And that probably sounds about right over the long run.
All right. We'll leave it there. We'll revisit this in a year and see how many survive. And like we said, it doesn't have to be an epic crash like the last time. Every time is different. It's really a question of probability and odds. And the odds in the long term favor investing not just in one thing, but many things. Okay. Federal Reserve here. I want to have a good debate here, Jamie. Everyone on here knows my take. The Fed should be abolished. We should get rid of this notion that 10 people sitting in a room should decide the most important interest rate for the largest economy in the world. But that's the system we've all agreed to. So we play this game of guessing when they're going to cut, when they're going to hike. My view has been there's absolutely no need for them to cut interest rates. We have the stock market at all-time highs. We have the unemployment rate here below 4%, 24 months in a row. That's the longest streak since the 1960s. So their other mandate, maximum employment, seems like we're doing pretty good on that front. And inflation, yes, it's come down, but this notion that just getting back to that 2% is going to solve everything, like inflation is, we won the war, then I don't like that notion. I think that we have to go below 2% to bring down that price. If you really care about inflation the way Powell is talking, he's saying we're going to stay at it till the job is done. In my view, the job is not done until you bring down the above 2% inflation that we've seen since the beginning of 2020. So, said a lot there. What's your take? Is the Fed making a mistake? Many people are saying the Fed's making a mistake. They should start cutting rates in March. Now the expectation is May. What do you think the Fed should do? And what do you think of this notion that getting back to 2%, like I'm saying, is not enough?
Yeah, well, Charlie, you're not alone in wanting to, destroy the Fed, and that actually happened. Andrew Jackson literally blew up the Federal Reserve in like the 1820s. Yeah, after Alexander Hamilton had created it about 30 years beforehand. So you've
Yep.
actually got historical precedents for what you're suggesting be done. I think it's a little bit too easy to pick on the Fed or armchair quarterback the Fed. Charlie and I are sitting here talking, and people are not micro analyzing every single word we say, like they do with the Federal Reserve, with the FOMC statements that come out or when these people speak. I think more that's testament to just how powerful, this small group of individuals has become. That just again a change of word can really really move markets, and so that's more my concern is just how powerful it has become, and for to be so concentrated in just a few hands. And I actually was lucky enough when I completed my master's overseas. I completed my master's in economics at the London School of Economics. I was lucky enough to have one of the heads of the Federal Reserves at the time, one of the actual name voting members. I won't name names, but this person was very nice enough to critique my dissertation. And when I received the comments back, I just didn't understand a lot of the things that they said, and I just assumed, which I'm usually right, assuming that I just wasn't smart enough to understand this brilliant thinking. But I actually took it to one of my other professors there who actually had worked at the Bank of England. Said, actually, no, like a lot of this didn't really make sense. So it made me feel a little bit better for myself, but more so, okay, these are still just people too. And for them to be so powerful, that's a concern because we're all fallible creatures. And the big problem they did last year, in just my opinion, was in part to coincide with the really healthy growth at the end of the year, just very explicitly denoting, hey, we're going to cut interest rates 3 times in 2024. Well, what if we only need 2? Or what if reasons justify 4? We kind of, I feel like it was unnecessarily explicit that we could have had the same impact on just saying, hey, we're planning on lowering rates and maybe decently being aggressive lowering rates without the markets focusing on a number. And because when you really think about it, Charlie, what would keep us from, lowering rates? You could say, yeah, inflation grabs hold again, but all the data continues to stay trend positively there. But what if just economic growth overall just continues to surprise to the upside? I mean, you and I as consumers we're just surprising markets over and over again. The jobs market, surprising markets over and over again. These are really great things.
That's good.
And so if we don't have to cut rates because things are going great, we shouldn't be forced to. But the markets are now kind of pricing it in. So that's the concern I have. I don't necessarily want to blow up the Fed like you or Andrew Jackson, Charlie, but
Yeah.
I feel like they're too
I
powerful.
think no, I think there's some regulatory function. So I don't want to completely eliminate. What do I want to eliminate is that human discretion to set the interest rate, right? You either use a formula or just let the market dictate it based on the supply and demand of treasuries. Why should a human not do it? Because we've seen the Fed get it wrong time and time again. If we look at this chart here, for a decade, we came out of the global financial crisis, and for a decade, they keep interest rates at close to zero. I mean, for 7 years, they wait coming out of that to hike at all. And when they start hiking, they do it extremely slow. What that creates is a lot of misallocation of capital, excesses. They weren't concerned, obviously, in terms of asset price inflation. Ben Bernanke, pretty much wrote the book saying we want this. It's going to create a wealth effect, and so on and so on. My view is that if you want to have someone set it based on a formula. Use core PC if they like that. Use whatever inflation metric they want, and say we're going to be X% above it, right? And that then there's no guessing. What is the Fed? If they're going to cut a few times, whether it's 1% or 2% above it or more, I don't know the right answer, which is why I don't want to have human beings solving this to the first place. And I've never heard a valid explanation for why 2% is the goal in terms of inflation. Why not 1.5% or 2.5% or 1% or 3%? No idea, right? And so, like, you're right. Them saying they're going to cut 3 times this year. Well, why three? What? Why not more? Why not less? They have no idea. Just like in 2020 and 2021, during arguably the biggest housing bubble in history, what are they doing? They're buying mortgage bonds every single month to drive mortgage rates even lower. Right? To me, that's such a colossal policy mistake that group now can't be trusted in terms of setting policy in the future. And that might sound overly harsh, Jamie, but the truth hurts. And they never want to talk about the pesky fact that they contributed to the inflation that they're getting credit now for solving.
Yeah, maybe us Middle Westerners are just a little bit more gentle in our language, Charlie. But you mentioned Ben Bernanke, and ironically, it was his quote was that understanding the causes of the Great Depression is the holy grail of macroeconomics. And if you study the Great Depression, it was in many capacities a man-made disaster. And the decisions made at the Federal Reserve, these man-made decisions at the Federal Reserve, exacerbated it more than any other out there. And so, yes, there are a lot of these examples of Federal Reserve over tightening, under tightening. I agree. Where these arbitrary numbers come from can all be debated. But it's also, you have to, Charlie, show some grace. And what about the things we avoided, or would 2009 been worse? I almost equate it to, let's say, that senator that proposes a sweeping security bill that has trillions of dollars going to beefed up airport security, just security in general, and he passes his bill on September 10th, 2001. We avoid this tragedy, but that person probably loses their job and gets voted out the next time over it. So it's easy with the benefit of history to know exactly what happened, but I think at least somewhat, maybe some elements of what we maybe missed from this that we'll never know about has to be factored into the equation.
Yeah, well, that's the argument we always come back to, because it's people at the end of the day. I think this is why the Fed will continue to do what they're doing, is because most people they want to believe in the idea that there's someone out there that knows more, that there's someone out there preventing problems, there's someone out there reacting to crises like we had in
Yeah.
2020, right, or 2008. Whether it's right or wrong, we can never prove, because you can't prove the counterfactual. We can't say in 2020 what would have happened if the Fed didn't start buying corporate bonds. We can't say what would have happened if the Fed didn't immediately cut rates to 0%. We can't say it. So they always have the benefit of the doubt in saying, we tried our best, we're throwing everything at it, and if it's not enough, we'll do more. right? That's a famous
Yeah.
Draghi comment, right? If it's not enough, we'll do more, and believe me, it will be enough, and we'll just keep doing it and doing it and doing it. So I'm
Yeah.
not, from a personal standpoint. Look, Powell seems like a well-meaning guy. It's just the amnesia in terms of forgetting the increases in the money supply that the Fed engineered and the cheerleading that they did of taking on this huge amount of fiscal debt. And now they're an apolitical organization. We don't talk about fiscal policy all of a sudden. Well, it's just a few years ago, you were happy to talk about it and encourage it. Like, that's the hypocrisy that gets to me. And I just think for a functioning markets, and we're going to talk about China in a little bit, like the contrast is obviously a huge contrast between the US and China. But one thing that we have in common is that this notion that there's a top down, all knowing group that can set policy better than a bottom up free market. We don't do it with the like bananas or how many cars to produce or anything else in terms of products. And that works out incredibly well for the US consumer over the long run. So why are we doing it with interest rates?
Yep. I mean, you're spot on there. We're in 100% agreement there. I mean, at the core of what Karl Marx thought of with communism, the fatal flaw ever, that you still needed this like small governing group of intelligentsia to run everything. Where no, absolute power corrupts absolutely. And again, it's not to that extent with the Federal Reserve, but the point is that they become so powerful, and again, powerful in a degree that maybe they weren't in prior decades. That absolutely is a concern. But for now, the two risks that concern me most, the things that keep me up at night. I mean, you know, you know, pandemics don't do it. Massive bear markets don't do it. Wars don't do it. The two things are, of course, massive cybersecurity breach that, right on accident or on purpose, something we just haven't seen before, and how much our countries depend on that, or just the global economy is dependent on that. Or if the markets lose faith in the lenders of last resort, that the Federal Reserve, for better or not, has seemingly been like the firemen that come in to help put out the fire when everyone else's fire hydrant is out. And if there's, how that dependence on markets right now, if there's a loss in confidence there, a loss in confidence of the lender of last resort, I think that's one of the two paramount issues I see. But I do not disagree with you in the least, saying that there is too much power there. And like anything, any organization, any marriage, any relationship, any sports team, you should continue to look for ways to improve instead of just sticking to certain things that just because it's always
Yeah,
been
we
the
have
way.
all this data today, right? Why are we reacting to lagging data? Like we talked about CPI a lot on the show in terms of the lagging nature
Mhm.
of the housing data. Why aren't we using real-time prices there? And why is the Fed reacting, even right or wrong? And I disagree that they should be setting it to begin with, but if they're going to set it, why aren't they looking at real time data and reacting, in that fashion? Okay, we did we talked enough about the Fed.
Yeah.
You and I think we probably agree on more than we disagree. But the lender of last resort, there's no retort I could give to that because we don't know in that situation, right? That brings up a whole nother, can of worms. Like, do we want to be like Japan and have zombie banks, and how far do you go with that? And is it bad or worse, right? The true libertarian in me is like, okay, we start over, right? And that's part of but no one ever wants to test that and see really what would have happened in 2008 had we not did what we did in terms of TARP and all the other programs. So I was willing to see, but not everyone
I
was
think,
willing to see.
Charlie, there's islands you could buy. I think you can incorporate. You can try and pitch your own thing. If you got the gumption, I think you could give it a shot. I'll provide guidance. I don't know if
We have Texas. Maybe we'll start
yeah.
it there and separate. All right, we'll save that for the next week in
Yeah.
charts. Profitability and paper hands here. I'm gonna run through this quick. A few years ago, when we had that 0% policy, and we had arguably the biggest mania since 2000 in certain segments of the market. Not everything, but definitely in meme stocks, high growth stocks, just everything trading on expectations, the future. I'm just going to run through a few examples here. Uber and Lyft. over the last 2 years. Uber up 93%, Lyft down 67%. Why the divergence, Jamie? Well, Uber's a profitable company now. All of a sudden, Lyft is still losing money. Meta, Facebook, and Snapchat. Look at the divergence here last 2 years, 113% for Meta. Snapchat down 71%. It's kind of crazy because the kids, my kids, everyone uses Snapchat. They don't like, you can't use regular text. They have to use
Mm.
Snapchat, but they haven't found a way to monetize. At least they haven't found a way to make it profitable. They just have a way too much cost infrastructure there. It's kind of crazy that they're still losing money right this far into it. And Snapchat is actually
Yeah.
down since its IPO, and Meta is now a money making machine again, even though it's throwing away billions of dollars every quarter on their virtual reality stuff.
Yeah.
They continue to do that, but they've come back roaring back in terms of profitability. And I think the best example in terms of the change environment is just AMC coming back to reality here. It was losing money back in 2021. Nobody seemed to care about that during the meme stock boom there. 2,850% return from the start of 2021 to its peak. And now it's lost almost everything, all time low. And AMC, it's losing money. So, what a shift in a short period of time. And this is another reason why I think we can debate whether interest rates should be 5% or 3%, but I think going back to 0% is not good because you have all of these businesses and all of this misallocation of capital going to ultimately unprofitable areas of the economy.
And you can fool some people sometime, but you can't fool all the people all the time. And you know what? I'm glad, my kids here, they're not old enough to use Facebook or Snapchat or any of them yet, thankfully. But hey, you know what? Facebook is making money as a company that is profitable. You should be rewarded for that over, versus a company that is not making money. And so that kind of fundamental uh, delta creating dynamic, that's a very, very positive thing.
It makes sense. Yeah. And like a lot of us were losing our heads in 2021. And like, I can't tell you the number of angry responses I was getting from people saying, you're crazy. It doesn't matter anymore. Like, all that
Yeah.
matters is growth. And fast forward to today, no one seems to be saying that anymore. It's back to reality in many respects. Even with the market back at all time highs, you still have a lot of these high growth companies still well off of their prior highs. And maybe a lot of them will never get back there again, similar to the .com peak. Okay, I want to talk about Mickey D's here. When was the last time you went to Mickey D's, Jamie?
Again, the same three kids. I was just kind of bragging about, I go there probably at least once or twice a week with them.
Okay.
And so
Have
we're
you
not.
noticed a difference in prices over the last few years?
So after the Chiefs win the Super Bowl, my wife and I are gonna go on a real diet until April 15th, tax filing deadline. That's kind of, with all the Super Bowls the Chiefs been going to recently, that's been an easy mark for us. But yeah, actually, when the kids I do know that I oftentimes get a McChicken sandwich, and I will admit that the dollar McChicken, I believe, was $2.39 the last time I went there. So yeah,
What's that?
I'm
The
seeing it.
dollar menu McChicken
The
or
dollar menu McChicken, I
is
believe,
now
was now
239?
no,
Okay.
it was 239. And so, or at least I don't know, maybe I got grifted or didn't notice, but I have noticed that. I was hoping
Yeah.
it'd be something that, we're avoiding, people are eating better, but I'm not. I ate a McChicken a couple days ago. And so,
Well,
but I did notice it was more expensive.
yeah, the convenience factor is obviously everything, and no, you're not usually going there because you think you're getting a better meal. What kind of shocked me is they just reported earnings. They had the CEO come out and he was talking about what you think about like this used to be a place for low income consumers, right? They could come, they could get a cheap meal for their family. That's not the case anymore. I mean, we're talking about in some locations, and I know this is not everywhere. Like you can get deals on their app, and every location, Kansas City is going to be different than New York and California, obviously going to be higher, but $18 for a Big Mac, fries, and a drink, right? When I think about that to me, that's just way higher than you would expect for that quality product. And they're like where is all the efficiencies gone with fast food? And essentially, he said low income customers have largely stopped ordering there. Like that whole segment of the market, it's become more of a premium place for people to buy food. They hiked prices 10% in 2023. I would suspect, I haven't seen a study on it, but just observing, I think it's up. It could be up 40, 50% since the start of the pandemic. That wouldn't surprise me in terms of prices at these places.
Yeah, it was enough that I noticed it. This is really surprising to me that, the low income customer thing. I mean, I can very vividly remember the McDonald's in Smithville, Missouri, Big Mac, fries, and drinks was $2.99. And so, I mean, dude, that's a 6x bump. Granted, it's a long time period, but that's still a move. Yeah, that's really interesting. You would have hoped that the answer was, a lot of these lower income customers that oftentimes lived in the so-called kind of food deserts where there just weren't even really high quality grocery stores. And you'd love to say that, okay, that's the impact, that these people are actually eating healthier. But unfortunately, that's probably not the case. It's probably they're just maybe, I don't know, Charlie, what's
What's
downstream from McDonald's?
Yeah, good. Well, let's go back to the grocery store, right? Remember when people used to say eating healthy was more expensive? I think the case is getting better in the situation that if we look at inflation at the grocery store, yes, it's been significant over the past few years, but nowhere near what we've seen in terms of eating out in restaurants and fast food places. And the
I mean,
number
that,
one reason for that, labor cost, right?
yeah,
Huge, huge shift. And this is a positive for anyone who still has a job, obviously, at these locations. They're getting paid much, much more. But we're talking about in California in a few months, $20 minimum wage special for only certain industries, fast food being one of them. And that's just that's an enormously high number for an entry level worker. This used to be high school kids, right? Having a part time job, and now you have to start them at 20. Well, that has to filter through if you're going to keep that profitability, and that's the one part of inflation I think that people aren't really appreciating, that it's not going to go back, right? So we've seen oil prices go up and then they come back down, right? Food prices in terms of corn and wheat and soybeans at a spike, they came back down. Lumber prices up and down, right? But wages don't typically go backwards, right? They only march upwards, and the stepwise increase we've seen over the past few years has been incredibly high. So I don't it's something that maybe could flatline, let's say, but this is a big divide. And maybe the good news is people will think twice about going to McDonald's. Maybe not you. When you have 3 kids, it's hard. It's easy. When I'm traveling on the road, like you're gonna get it, right? You're like you stop in, you need to get something quick. Nothing else is open. You're gonna do it, but like as like something that you would go to more frequently, maybe people. I'm not being optimistic. They'll think twice about it and find some maybe healthier alternative that maybe takes more time. Is that a crazy
yeah.
thought?
If that actually becomes the case, I think from a strategic standpoint, that would be wonderful. Cure a lot of our ills, a lot of strains on our system, just people living unhealthy, lifestyles and not moving around enough and eating too much fast food. If we can actually, if that's actually what the byproduct of this is, Charlie, then maybe one of the more strategically important things we'll ever talk about.
Right. We used to buy like a Happy Meal. You would get like
It's
apple slices with it, and my line of thought, oh, that cancels out some of the fries. I don't know. Anyone nutritionist listen to this would probably disagree with that, but that was in my mind justifying it. But just last point here on McDonald's, from an investment standpoint, been a pretty good stock since the inception of the S&P 500 ETF. Obviously, not many stocks outperform the index over a long period of time. McDonald's handily outperforming, up over 9,000% since the inception of SPY in 1993. So, pretty good business for a long time. And you look up what it's trading at, Jamie, this is a fascinating thing. It's trading at very high valuation for this type of company. So, like a lot of optimism that they're going these price increases and the story that we're talking about isn't going to hit demand, and that we're going to continue to see that. So we'll see. We'll revisit
yeah,
this in a few years and see if perhaps this was pointing to some type of peak for McDonald's. But
yeah,
the notion that we're going to see prices come down at restaurants, after they've gone up? I don't think so. Like, and what's the incentive if they have the demand and they raise prices and they're not seeing any pullback, meaningful pullback in terms of sales? They're going to keep prices high, right? That's
Yeah.
just
Yeah.
capitalism 101.
It never sunsets. Yeah. We balanced the budget for a momentary period. That just means for a momentary period, it didn't go up. It didn't go up anymore. What I see from that graph, I guess that investors have been loving it at McDonald's more
There you
than
go.
more than
Okay.
customers.
Yes, for sure. Okay, let's talk about office market here. And this is something we covered, but another record high in terms of vacancy rate, 19.6% in the US in terms of office rate vacancy rates. And Jamie, as this rolls off, right, people have for offices long leases. And so every month, more of these old leases are rolling off. And what companies are finding out very quickly is they don't need as much space. So it's not like they're abandoning their office altogether. They're downsizing in most cases, unless they're growing significantly. And the reason for that, as we're showing in this chart here, we're still about 50% now in terms of back to office across the country. And so you have office space that was built for 100%, right? And it obviously wasn't fully occupied, but it certainly wasn't built for 50%. So do you think this is just, it's going to trend upward and perhaps it just hasn't been long enough, or this is something, really a change, sea change that isn't going back to the old model?
Well, I hope it trends higher just for my own experience. The look being around people, just being able to absorb information, learn from them, learn from my, peers, more experienced senior members of the team was so invaluable for me through the years. And I just don't feel like you get as much of that over, Charlie and I on Zoom here. So just from my personal experience, the concern is what you see here. I mean, we've kind of flatlined over, COVID's enough in the rear view mirror, but these numbers now have kind of flatlined and stayed consistent between that 50, 60, 65 range. And calling it what it is, I mean, COVID was one of those lurch moments for society that really only happens every 30, 40, 50 years. I mean, COVID, or this, say 9/11 maybe had that impact. Before that, kind of, the Vietnam War and the civil rights protests, that, maybe Second World War, First World War. So these really moments that the hinge shifts don't come around that much. And COVID appears to be one of those. And one of the biggest unknowns still from that is just how the commercial office space is going to respond. Actually, how we look at it, Charlie, from an investment standpoint, we're actually have high conviction actually in the private real estate side. We're actually often trying to utilize that more in both public, but also in the private real estate side, that's able to actually dramatically avoid or even eliminate completely exposure to that commercial office space segment right now, just because there's so much uncertainty out there. We're so in the early innings of this huge lurch adjustment for society. I hope it returns, but again, the flatlining of this says, we might be in this pattern for some time.
Yeah, there's I guess two ways to look at it in terms of is this going to come back or should it come back? And one argument would be, well, we saw how well that hybrid, at least hybrid model, worked during COVID, and for a lot of people, it was helpful, right, to have that balance. Some days in the office, some days at home, and then we had coupled with that, Jamie. And this is the reason why, big reason why it's persisted, is we have this shortage of labor, right? So you have, we talked about the low unemployment rate, but employees for now have the upper hand still, and they don't want to go back every day. Not that they don't want to work, but the commute, all the rest of it. Some people would argue they're more productive at home. We could debate that. I think there's a lot of debate. Jamie Dimon would not agree with that statement, but overall, what technology showed us is that it can be done, right? And if something can be done more cheaper, more efficiently, with less time spent in terms of travel and the rest of it, and less office footprint for the employer as well, and saving money there, it likely will be done, right? And in a knowledge economy, like, to me, it doesn't make sense to go back to the old model completely. Now the question raised then is what are you sacrificing? And the big thing, I think you hit the nail on the head, is training. The younger workers are really losing the most because if you're not in the office, you're not getting that same learning experience over Zoom, right? So people that work for you, they're hearing you say things to other people. They're in whatever, we can debate the value of meetings, but by us through osmosis, they're learning things that you couldn't learn being just virtual, for a meeting a few times a week. It's just not the same thing,
Yeah.
right? So that's not a small insignificant thing. Is that right?
Yeah, no, you're absolutely right there. And again, I'm only gonna speak for myself. I can work at home. I don't work as well from home. And again, that's just me. But to you said the ability to just absorb stuff and just through my 25 plus years working, the best ideas haven't necessarily come when, hey, let's all hop on a Zoom call for an hour, 2 o'clock on Tuesday and come up with good ideas. Oftentimes it comes out, we're pack animals, being around each other. There's some benefit to that. We picked on AMC, kind of an origin Kansas City company earlier. There's a benefit to going to movies with those you love. And so I personally hope it recovers, but that's a real uncertainty, and we're trying to be cognizant of that from an investment standpoint right now.
Yeah, and at a certain point, right, the prices come down enough where it's reflecting that. And if you've read the stories, right, in San Francisco where it's like 80% this building is down, and maybe someone comes in there and they don't care about the occupancy and they, wait it out, or even at that level it becomes profitable, right? So there's going to be distressed opportunities. The
Yeah.
question is, in terms of the cycle, in terms of the lending cycle, many of these loans haven't come due. We don't know what the reaction is going to be at that point. And if this is a secular trend, then it's going to take a few more years for the leases to go down. So it's like, if you
Yeah.
have expertise in the space, I have no doubt that there's going to be a lot of opportunity in the next 5 years.
From crisis comes opportunity. One thing I see a lot of things saying, well, hey, like you said, San Francisco, these are great urban centers. Let's just convert these things into residential. Well, that's easier said than done to turn my office into a bathroom and a bedroom. And so, yeah, a lot to be said. Yeah, there will be tremendous opportunities
Yeah.
coming out of this. The market does find a way, but I hope people get back to work. Personally speaking, just from my own experience, um, for all those
Yeah.
reasons we
Well, it's
discussed.
amazing. Everything else seems to the if we look at gyms, we look at live entertainment, we look at you mentioned we're talking about the Super Bowl, right? It's going to have
Yeah.
a stadium filled of people. Las Vegas is supposed to have 500,000 people going there. Like everything else, bars and restaurants are doing well. Everything else, travel is back, surpassed 2019 levels. Everything else has come back in terms of that stuff, but like the urban city centers like this stuff, it just hasn't come back yet. And maybe it'll take a recession to really move the needle here. Maybe, like I said, that supply demand and that imbalance as the labor market starts to loosen up, then you'll see a change here. I'm not sure. Like I think it's been a paradigm shift, and you don't go back to the old model. You find the best model that works for your particular company, and you iterate around that. But
Yeah.
I want to talk about the impact. So offices down 25% in the U.S. on average. The impact on the banking sector here, a little bit. New York Community Bank, not a huge bank, but down 63% this year. Some rumblings, oh, we're going to have another Silicon Valley bank moment here. We got regional banks down 12%. S&P 500, once again, could absolutely care less, it seems like, at the moment. Does not pricing any sort of trouble here. Is this a canary in the coal mine, or is the Fed at any point, let's say NYCB fails, they'll just come back right back in and do what they did in terms of Silicon Valley and Signature and First Republic?
I'd almost just say, Charlie, there's always something like a NYCB going on in the markets. Some particular business is just collapsing or exiting. The names in the indexes change all the time, but they somehow find a way to maintain and grow. So I wouldn't see this as canary in a coal mine. It's unfortunate that this bank, its customers, and its employees are clearly going to be suffering from this, but you can change out that name, plug in anything, even in the best of years. you're probably gonna find something. And so, yeah, the markets don't care because usually they shouldn't care about these things. But you never know when these things occur all the time, turn into that fuse that lights the bomb. But if anything, it seems like the market's reacting as history should say it should.
I guess it's rational if it's going if it's a similar situation to those banks. We learned last year that second, third, and fourth largest bank failures in history does not prevent most of the other S&P 500s from companies from doing incredibly well. Right, profits rebounded, markets up 26% total return last year. So we learned that it can be contained, and maybe that's your argument for the Fed that that would have. Well, we don't know, but maybe that
Yeah.
would have turned into something much worse had the Fed not done their lending programs and all the rest of it. So
Well, don't let the law of big numbers fool you, though. What you said, second, third, and fourth. What in the late 20, 29 through the early 30s.
yes.
Thousands of banks declined. Investment geeks like me were jumping out windows. Unemployment rate is 25%. So you always got to look at the
A
relative
lot of
number.
people are yelling at me. It's not inflation adjusted, but even if you adjusted for inflation, it was pretty sizable those banks. But okay, we got to
Yeah.
talk about China here. I know you have some thoughts on this. I've covered China in terms of markets. Obviously, China's stock market down over the last 10 years. S&P 500 more than tripled. Huge spread. Many issues with China. Real estate problems, demographics, a lot of talk around this stat right here. Fertility rates approaching 1 for women. Obviously, that's not very good in terms of a sustainable population. And in fact, their population is now going down. They had 9 million births in 2023, record low. The population declined by 2 million in 2023. What an ironic situation in terms of only a few years ago, you got the one child policy and they're using threats of jail and fines and everything else, all inhumane things, anything you can think of to prevent people from having more than one child. And today, they're doing the exact opposite. They're sending messages to women, all types of methods trying to get them to have more kids, and it's not working.
Yeah. They built their society around, these draconian policies they put in place after, the Great Famine when they couldn't feed their population and had a lot of bad things going on. These draconian policies were in place for quite some time. So society was formed around a one-child household. You can't, those, you know, Pavlovian adjustments don't turn on a dime and just, cost of living, women not being more educated and not having kids so early. There's a lot of factors on it. And yeah, demographics are destiny. It's funny. Three of my best friends at work, I was emailing them last weekend because all of them were either joining me in the three kids club, getting over that 2.1, stability rate, or even going in the four. And so I wasted time kind of, you know, kind of talking about this with them. Well, that's so important because, you hear Elon Musk talking about this stuff. Jack Ma, Alibaba would talk about this stuff. And it's really, this stuff moves slowly. You can make a lot of good analysis off of demographics because it doesn't change quickly and trends continue. And the trend here, again, 2 years in a row of population decline. The only 2 years were during the Great Famine when people were starving to death. That is a problem that China has essentially eradicated. And so, yeah, that number is getting close to 1. I saw something. There's some provinces in China that it's below 1, like 0.6, 0.7. Like that is
Yeah.
shockingly low. I mean, I want to say even North Korea is like that too. I think Kim Jong Un did something where like the women of the revolution, it's your duty to have more children. Well, he's saying that because they're not having enough kids. Would you really want to have more kids if you're so poorly managed that you're like a half an inch, or you're essentially 6 inches shorter than South Koreans, and just because you've been eating so poorly for only 3 generations, like it's not supposed to move that fast. But I wouldn't want to have a lot of kids in North Korea either. But China's not North Korea, but it's an issue. And the amazing thing with this, Charlie, is that there were some stats that like I said, with this data, China's got about 1.4 billion people in it right now. I think India just recently bypassed it as
Yep.
the most populous country in the world. But um, I think it was a UN that measured at these rates that 1.4 billion people is going to turn into only 500 million in the year 2100, just the end of this century. That's really not that far from now when you think about that. That is such a huge, huge move, such a huge, huge impact to the economy. At the end of the day, a lot of these major historical moves occur because of that. I mean, the Berlin Wall was constructed for primarily economic reasons. And so the potential ramifications of this, does it make China realize they're making poor policies, or does it make them lean into poor
Right.
policies? Does it make them more aggressive in the Taiwanese straits and all the uncertainty there? The ramifications of this, again, just essentially an economy, contracting in population that dramatically is huge. And so we're not talking about this enough. And there's a lot of issues like this with China. The only other one, Charlie, I want to highlight, their youth unemployment rate was so bad. It was like 25%. So the Chinese, they just stopped reporting on it. And
Yeah.
that's another thing. Again, when it's interesting, it doesn't impact gals as much as guys. But like when you have a bunch of young guys sitting around not having much to do, that's usually when things go really, really, really bad for societies. We talked about here, we've got the other problem. I mean, we're paying 16-year-olds $20 an hour to flip burgers, and their youth unemployment rates are so bad that they stopped reporting on it. So just the potential ramifications of this longer term, I don't think has nearly gotten the attention that it has, because demographics can play such a powerful role over the long run.
Enormous. Yeah, you said a lot in there, and you're thinking this is we're seeing this. Put this in context. We're seeing birth rates decline across the globe, right? China is just more extreme, right, than anywhere. So even in the U.S., we're seeing it go down, but nowhere near. So it's going to take time to really see it, right, in 20, 30 years. But unless something changes, like this is going, as we said, you never want to have the situation where the population's aging this quickly, because it starts to become a big problem. So it's not, talk about destiny. It's not preordained, by the way, that this will continue, in 2020 until 2100, and they're going to have 500. But like perhaps something will change. To me, the best thing they can do when it comes to China, I'm not expecting them to do it, is to increase personal freedoms. Right? Just give people more freedoms in their everyday lives, and they're more inclined to have more children. It boggles my mind to think like this is from a top-down perspective. There was someone sitting there 20 years ago saying like we have to limit the population. There's one and they probably had all of this data and evidence or why we have to do it, and now they've run the numbers and they think the opposite, right? The same thought that from a top-down perspective they can determine what's the right number of children for a woman to have, right? It's just a ridiculous concept, but they're doing it in every other aspect, right, of the economy, and all of the successes that China has had in the last 20 years, and it hasn't been nothing, right? Their per capita GDP has increased dramatically in the last 20 years. All of it was from increasing economic freedom, right? And free trade, liberalization of markets. And it seems like in the past few years, they're actively trying to go in the opposite direction for whatever reason, like consolidating that power. Like they reacted to COVID, and I don't want to get into too much of it because this is a whole nother story, but they reacted to it in the worst way possible, controlling the population even more than any time we've seen in history, literally locking people in their homes, lying about the origins of the virus. So I don't trust any data point. The fact that they stopped reporting the youth unemployment rate there, to me, even if they report it, I don't believe it. Like there's no number that you could tell me out of China where I'm like, yeah, that I could believe that. I don't believe it, any of it. The fertility rate, if they're saying this is the decline, it's probably 10x that in terms of population.
Yeah, you never know. And unfortunately, like you'd say, there'd be more freedom, but typically, especially in a command economy like that, bad ideas almost lead to more bad ideas until it's almost too late. And then again, what's the ramification when there actually is an adjustment? Another interesting stat that just came out that, about 18% of China's population is over 60. And that's essentially going to double over the coming decades to be far higher than the US. And so again, they're just their demographics are, they're aging dramatically like a hockey stick beyond us. People like to pick on the United States. It's like picking on the Chiefs. It's easy to be like to pick on the alpha dog. Well, our demographics compared to the vast majority of the world, I mean, the vast majority of the world that's not like having problems feeding their own people, ours actually look very good. And yeah, we bash China, but Charlie, you pointed earlier, one of the greatest economic miracles of the last 30 or so years was essentially a billion people, more than a billion people being ripped out of abject poverty, kind of starving, very getting by that this Chinese economic growth did. So just for human civilization, it's been a great thing. But to your point, what drove that? A lot, becoming more open, and it seems like we're trending the other way now. And unfortunately, that's probably a negative thing, and the potential ramifications and splinter out in a lot of different manners.
Yeah. Okay. So there's more to come with that. We're going to break down a lot of different stuff next time you're on with China because it's just so fascinating. But I want to end, as we always do on the show, with something positive. And this is a kind of a crazy stat because we're hearing a lot of negativity with younger generations and how they're struggling. And yeah, a lot of that may be true, but here's an awesome stat in terms of the increases in wealth in three different age groups: 18 to 39, 40 to 54, and 55 and over. And far and away, 18 to 39 year olds, Jamie, increase in wealth since 2019. You're looking at a over 70% increase in net worth. And that compares to roughly 30% looks like for 55 and over, and 40 to 54, our age group there, not doing so well, 10% increase. And fascinating thing in terms of what's driving this is it's not just housing. Housing's up across the board, over 40% on average in terms of increase in home prices, but the financial assets. So that stimulus, that the programs that we did, the 3 rounds, the younger people got a higher percentage of that in terms of their net worth. And yes, they spent some of it. Yes, they probably lost some of it trading AMC and GameStop. GameStop, maybe some of them sold at the peak too, hopefully. But a good portion of them actually invested it. And we've seen obviously increase in financial markets and they've benefited from that. Does this stat surprise you at all?
In a lot of ways, it actually doesn't. Peeling back the onion a little bit more, you know, older generations like us, if older generations aren't complaining about younger generations, then something's gone wrong with society. Like an old caveman was complaining about young cavemen for not, skinning a saber-toothed tiger appropriately. But what I actually think, what you hit the nail on the head with a lot of these, but a lot of great things that we've done in our profession, Charlie, to empower people to invest earlier, because it's all about the time value of money, letting that compound grow over and over for you. And a lot of these younger workers, again, we manage, hundreds of billions of dollars in retirement plans, and we are huge, huge, huge advocates of automatically defaulting people into the plans. So as soon as you sign up, boom, you are investing in the 401k. Whereas before, when you and I were starting off work, Charlie, and all older workers, I mean, a lot of older workers, the 401k wasn't around yet. But that example, you had to make the determination that I want to do this. Now we flipped it on its head. We've gotten the laws of inertia on our side, saying actually, no, the action you have to take is to do something negative, not something positive. So a lot of those positive things, I think the impact on overall growth rates, getting these people invested, when they're 22, 23, 24, instead of people only kind of waking up when they're our age and say, hey, maybe I should start doing something. I think that's a huge positive. And then also just, again, we can complain about technology. I'm keeping my kids off a lot of it, but like, it's just making it easier to make these sound decisions, getting help budgeting, if you're willing to do, if you're willing to take the time, the resources at your fingertips are much more dramatic. And so I think in a lot with these policies in place, corporations making these policies, individuals taking advantage of these applications, or at least letting it automatically happen on their behalf, is going to be a huge positive. And in some ways, you might not just see this continue to grow. I think it'll stabilize with younger generations, but a big part of that is everyone who joins a company now, they start investing day one. And the beauty is they keep investing no matter what. Markets go down 30%. They tell their friends, "Oh, I'm not investing. Are you crazy?" Well, they are, because they're still having those biweekly or whatever contributions. And it works out hugely on their behalf over the long run. So I think that's a big component of it too.
Awesome. Yeah, I'd love to hear that. The behavioral nudge is extremely important and a great use for technology. So keep saving, keep investing. I love to see it, and maybe that retirement crisis that everyone's worried about, maybe that's not going to be as bad as everyone thinks. Certainly, if you look at the growth and wealth over the past few years, that certainly should have helped overall. All right, Jamie, thanks for joining. Thanks everyone for watching. This has been an awesome week in charts. We're going to do this again, Jamie, so hopefully you'll come back. Have a great weekend, everyone, and we'll see you next time on the Week in Charts, and go Chiefs.
Yeah, go Chiefs. Thank you. All right. Thanks, Charlie. Have a great weekend, everyone.